Good afternoon, and thank you for joining us for today's roundtable on commercial real estate investment opportunities. I'm Bob O'Brien with The Deal, and I will be moderating today's discussion. In an investment world where investors fret that publicly traded equities may be in a bubble, real estate is an investment class that our experts argue are actually trading at a discount to their book values. Now, we've assembled a distinguished panel to address the current state of the commercial real estate market and how smart money can take advantage of the opportunities to be plumbed here. Joining us today, to my left, Brian Ward, President of America's Capital Markets and Investment Services for Colliers International. Beside him, Janice Stanton, Senior Managing Director of Capital Market Group for Cushman & Wakefield, and Kathy Barthmeyer, Executive Director of WP Carey. Now, we've got a lot to cover, so let's get started. Now, recent data has indicated that the economy has improved, so let's start top down. Brian, let's start with you. How has this manifested itself?
I mean, look, for sure, GDP growth is strong and showing long-term strength. Wage growth is a concern. Job growth, I think, is also showing some strength as well. But again, wage growth is the one piece that I think that really makes me a little bit nervous right now. I think we need to see long-term wage growth return to a level that outpaces inflation before we're going to start to see the type of sustained recovery I think that everybody's looking for.
And Janice, let's talk about this. What's your takeaway on the economy right now?
Sure. I mean, I think, it's been lackluster relative to prior recoveries, but at the same time, the numbers are pretty darn good from a global perspective. So for a mature market, the US is a mature market, you compare it to the UK, you compare it to the EMEA, we look like a rock star. So, from a real estate perspective, that means while we haven't seen the kind of breakneck, breakout rent growth that we've seen in prior recoveries, we've seen good, steady increases, somewhat boring. Boring is good in real estate because it extends the length of your cycle. So we've seen falling vacancy rates and increasing rents across all property classes. So that's a good thing, and it's actually in direct contrast to some of what we see around the rest of the world, which makes us more attractive.
And this is good, as opposed to 2007 when we had bubbles.
Well, 2007, I think, people say cap rates are similar to 2007. Oh my gosh, is it a bubble? And I say, well, look at the differences. Rents are only 2/3 on an inflation-adjusted basis relative to what it was in 2007. So I think there's increasing kind of rent growth opportunity there. At the same time, interest rates are a couple hundred basis points lower. So we have a positive carry trade. So people investing in real estate today, in 2007, you made more money in treasuries than you made in real estate. But today, you got a positive basis trade. So I actually, if you get a rent spike, I get nervous. But at the current level of interest rates, I'm feeling okay about the market.
And Katie, is there I'm sorry, Brian.
I was just going to say that just to emphasize what Janice just said, that spread today between interest rates and cap rates is very, very important as we go forward.
Absolutely. At WP Carey, we focus on the long-term single-tenant net lease transactions. And to agree with Brian, our business is really driven by the spread between interest rates and the cap rate at which we can buy investments. And so I think with the improving economy, we're all expecting that interest rates will start to move up ultimately, and that cap rates should increase in tandem.
So how is the economic recovery evidence itself? Is it in pricing? Is it in investment activity? Is it in demand? Is it in inventory? What's the way it's?
So the quick answer is yes to all of the above.
Yes,
I mean,
yes, and yes, I would say.
So we've got obviously, as we just mentioned, we've got great solid GDP growth. We've got great solid job growth. We have too much capital chasing too little real estate around the world. That excess liquidity is driving massive amounts of demand for real estate product in the face of not a whole lot of great alternatives. And when we talk about yield, so all of those factors are pointing to really a strong real estate market, and particularly in the United States, when we look at some of the other global alternatives and global challenges going on, everybody pointing their arrows at the United States right now.
And also, but I think one big leading indicator before it comes out in the stats is what are tenants doing? How much confidence do tenants have today? And what we see from a tenant perspective is whereas a year ago, maybe 75% of people, when they're looking at their leases rolling, they would stay in place. People stay in place when they don't have the money to move, right? Now we're seeing a lot of new leasing, which shows that tenants altogether, the corporations, that run America, feel that they have more confidence in the economy, they're more able to move. I think that gives us kind of better rent growth prospects going forward. So I think that leading indicator is actually quite positive in the office market.
And Katie, before I get to you, Brian, I want to follow up on something you said. You said there's too much money chasing inventory, too much capital chasing too few goods is something I used to think was called inflation.
Well, it certainly has created an extraordinarily competitive marketplace, really, for real estate globally, and it's just a function of too much liquidity in the marketplace. We've seen it since the global financial crisis. There is a ton of capital out there looking for return in relation to risk, and so that will continue to be a major force. And I think a dominant theme in our industry for some time to come here.
Yes, in our space, I'd say there are a lot of investors that are looking for income-generating assets. And so we have the benefit of being able to invest through all cycles, and as global investors see opportunities around the world, which allows us to kind of pick and choose the best opportunities that we think are most interesting. We recently closed a transaction in Spain, actually with the Spanish government, the state of Andalusia, where we bought about 70 office buildings that are occupied by various government agencies and entered into a long-term 20-year triple net lease. So Spain arguably is one of the hardest hit economies during the downturn. We saw an excellent opportunity on a risk-return basis.
Okay. So this is a really important point, though. Given the market that we have and given the spread today between cap rates and interest rates, if an investor is able to drive the bulk of their total return from current return, i.e. cash flow, because of low interest rates and that high spread, it takes a lot of risk away from the residual portion of the return. So it becomes less of a factor. So that's why investors are so anxious to be invested today, is because they can get so much return from cash flow. It's really a key part of this. And is if we start to see that cash flow component of the return begin to erode, and therefore more emphasis placed on the residual component of the return, we're going to start to see some challenges in the marketplace.
And Janice, that leads to my next question, which is how far in the future can we project this, given the interest rate environment? I mean, we're at zero.
It's funny that you say that, because in a world of kind of geopolitical instability and ISIS and everything, I think your ability to project far into the future is actually quite reduced from what we used to be able to expect. But right now, barring some kind of black swan or geopolitical event, if you look at your base fundamentals, you can project out, 2-3 years pretty steadily in terms of what construction is doing, which frankly is relatively, subdued relative to long-term trends. I mean, people really learned their lessons in 2007. Banks lost money, debt got taken back, and, what we've seen is, although there's an incredible amount of equity, as Brian has said, that's absolutely true, there's an incredible amount of equity, there's still a fair amount of discipline, far more discipline than we saw in 2007. I think it's the debt that's creating this discipline.
It's
So are
funny.
there shovels in the ground? I mean,
In multifamily a ton, in office not so much, relative to the disciplines. And if you look at the numbers, I mean, the numbers that are in it for multifamily are because the millennials are behaving differently than prior generations. Prior generations, the first thing you did was, you wanted to buy a house as quickly as you could. But millennials grew up around the dinner table where the conversation wasn't, let's buy a home. It was, I lost my job and I ruined my credit because I owned a home. I lost all my equity. I couldn't move to a new state because I was stuck in a home. So millennials were seeing home ownership go from 67%, down to the 60-ish. And I think that at least for the near term, until those lessons wash their way out of the system, we're going to have much more multifamily demand than single-family residential demand, because of what's happening with the millennials. And the millennials are, net of immigration and such, the peak is actually higher than the spike of, the baby boomers. So in the same way that the baby boomers remade America with suburbanization, I think the millennials and their emergent trends are going to remake real estate now in a different way. And it's urbanization and densification. It's not suburbanization.
It's interesting, Janice, that you just brought up the increased controls in the real estate market now. I just read an article on real estate's contribution to economic growth, and the gentleman was quoted, stated, how there is so much improved controls. There's lower use of leverage, increased use of equity, more third-party investment committees. And when I read that, it struck me because that's how W.P. Carey has always operated, and that's how we will continue to operate into the future.
Okay, and listen, we're not economists. We're real estate specialists. But Katie, I'm going to ask a question to you. The interest rate outlook. Mm-hmm. It's not going to stay at zero forever. What's W.P. Carey's projection for where interest rates are going? How quickly do they move up? And what impact does that have on your market?
Sure. I think interest rates do have to increase with time. The Fed just announced last week that they're going to keep them lower longer, and I think they're very tentative and trying to manage how they increase. We at W.P. Carey in every investment are very aware of the interest rate environment, and we're long-term fixed-rate borrowers, either on the balance sheet or on the asset level. So, and for each of our transactions, we're analyzing, okay, what's the refinancing environment going to look like, running various sensitivity analysis, and making sure that that's factored into our pricing decisions. Also, as global investors, we have access to global capital markets, which is a huge benefit. We just issued a 500 million euro bond at 2%. So not only is that a very attractive rate that we can price into our transactions, but it also helps us kind of hedge, as it's almost a natural hedge for some of our European investments.
Yeah.
And
I mean,
Brian,
Bob, I would say it's my opinion that the U.S. Central Bank is way more dovish than they're willing to admit. I mean, I think there's a lot of external forces that they're watching very carefully now. I think I mentioned earlier the wage growth versus inflation component of this. I think the wage growth piece is actually extraordinarily important. So I obviously don't know. I wouldn't be surprised to see the central bank move rates just to show that they can. But if you look at even if you look at the forward trade market for the 10-year U.S. Treasury, I actually went and looked at it before coming on the show. The February 2016 Treasury is trading around 232 today. The February 2017 Treasury is trading about 250 today. So that would suggest to me that the foreign markets, the currency exchange markets, are very dovish about where rates are going. And like I said, we may see some moves. And then clearly, as more factors come into play, that could all get revised as we go forward. But for right now, I think given a strong dollar, given declining oil prices, given concerns about contagion effect from the global markets, we know what's going on right now in several European markets. We know what's going on right now in several Asian markets. I think there's going to be just a tremendous amount of caution until we see that sustained recovery really in place.
But even this conversation we're having right now that's so analytical is in direct contrast to what we've seen in 2007. Because we're parsing everything, and being very disciplined about what we do. In 2007, the conversation went like this. How did you pay that much for a building? Well, I only had to put 3% down, and I earned 1% fees per year. So at the end of 3 years, I've got a free option on the building. That's why I paid that much for a building. Okay? Today, it's very different. People are putting real equity into deals. They're putting 25% equity into deals. They're being very analytical about what they think is happening in the economy, what's happening globally. So, when you ask the question about bubbles, I think that in and of itself, this conversation versus the conversation in 2007, in a nutshell, it's a complete
we're not talking about a bubble.
change.
Yeah, we're not. I think mature market, or something like that. But I don't think this is a bubble discussion right now.
Yeah. So, Janice, this is structurally, we've changed, and for the better.
No, absolutely. I mean, I think that you can say that you change because Either you've learned your lesson because of something that happened, and a lot of people had a lot of lessons learned, post 2007. The question is, how long are people's memories? Is it a long-term sustainable change, or is it the same guy who got slapped in 2007 is still sitting in the same seat today? That is left to be determined.
That's
I'm laughing only because yesterday I had my national team call and we were talking about debt underwriting standards, and I'm hearing more and more discussion about interest-only loans starting to creep back in, longer term IO,
but still discipline.
For the time being,
for
absolutely,
relative to long-term averages.
Yes.
Less disciplined than last year.
Yes,
But
memories can be short.
Okay, memories are short, and history has taught us that we tend to fight the last war. I mean, we won this one. Can these structural changes really? It doesn't sound as though you're saying structural changes are going to be permanent part of the landscape.
I mean, right now, the investor mentality, the capital markets mentality, all are remaining fundamentally, I would say, disciplined right now. I think it's much different than 2007 today, and I think it's not just the U.S. capital markets, but I think it's the global capital markets that are remaining so. So for right now, I'm okay. I just think memories are short. I mean, I've been in this business long enough to see it. So we'll see what happens.
And Katie, how far out do you take the interest rate equation? I mean, do we say the Fed is going to raise, incrementally over a period of time, or is there going to have to be just a departure point where all of a sudden the Fed says, we're going to have to go way up?
I definitely see it being an incremental increase over time, and I think they're going to be very cautious and very optimistic. I mean, even when you're parsing the word patient, they're nervous to take that word out of their statement because they're concerned that the markets are going to react and inflation isn't where they want it to be yet. So I think it will be a very measured increase in interest rates.
And I'm going to inject my personal opinion, which
please do.
Take it for what it's worth, which is that we really parse what the Fed has to say. But if you look at the overall tone of what they're saying, they tend to change the vernacular, but they change it in ways they trade one phrase for an almost comparable change. Mm-hmm. And somebody who's day trading, which you folks are obviously not in a position of doing, but somebody who's day trading looks at it and says, oh my goodness, they took this incredible phrase out and they've replaced it with something that's almost comparable. So from my perspective right now, the Fed remains relatively dovish. Obviously things are going to change down the road. However, at the moment we're not at an inflection point.
My worry is I personally think the Fed has done an amazing job under extremely challenging circumstances. My worry is that we've now embarked upon this grand monetary experiment over the last couple of years. And while the Fed says, I've got it, I'm not convinced that they do. And I'm not saying that they're not competent or anything like that, just the opposite. I think they're extremely talented under very, very difficult circumstances. But now we're talking about unwinding from something that we've never done before. And I see these struggles and this volatility in the marketplace, and as we parse words and we try and search for just the right types of nuances as we try and affect the market, I think it's a very difficult task for them to unwind this, particularly in the light of other global challenges that we have going on and other external factors. I mean, actually, to me, that's one of the biggest risks is how we unwind from this, but also exogenous effects on our economy as we try and do so.
But while the unwind may be tricky, and I agree the unwind is very tricky because of all the quantitative easing that's gone on, not only in the US, but abroad as well. You've got to look at, in an alternative asset allocation structure, what's the most attractive or what's the least attractive asset out there today? And real estate looks pretty darn good compared to bonds. Like, look at where bonds are, interest rates are going to go up. Look at where the stock market is relative to prior peaks. Look at where real estate is relative to prior peaks. And real estate overall is maybe about 10% above prior peak levels. The bond market is way ahead of that, right? So from a relative asset allocation standpoint, you see investors all over the globe pouring more money into real estate. You see it Norges, dramatically, the largest sovereign wealth fund, dramatically increasing their allocation to real estate. You see the largest domestic investors, CalPERS, increasing their allocation to real estate. So while we may gripe about little bits and pieces of the real estate market that we'd like to see more disciplined or better, we're like the least ugly asset out there, right? In this world of quantitative easing.
And Katie, let's talk about that. Does real estate remain a relatively undervalued asset versus, for instance, the equities market, where there's fear? I mean, the Nasdaq is back to bubble levels. The equity markets are trading at record levels. Are real estate assets trading at a discount to other capital assets?
I do think that real estate remains an attractive asset class and is a good kind of diversifying asset class. So I think that it makes sense. Again, people are looking for the income generating assets, and so I think it makes sense to put a portion of your capital allocation into the real estate market.
Now we're talking about global conditions, and one of the realities of global conditions is that currency markets have a great deal of inequity to them. The dollar is at a ridiculous is a wrong word, but the dollar is at a high. Other currencies are not. Brian, talk to me about currency risk and how you factor that into your global asset.
Well, I mean, look, you're right. So the dollar has strengthened, obviously, significantly over the last year in relation to other major benchmark currencies. I think the currency trade component of our business, for the foreign investor, it might have been a more relevant discussion 18 or 24 months ago. But I have seen in my work more of a fundamental shift from being yield-driven, and therefore being yield-driven, being more concerned about currency risk or taxation risk and the like, to today being more capital preservation-driven for foreign capital. So while I think it's important, and I think we may see some changes in foreign direct investment in the United States because of a strengthening dollar in relation to the other currencies, I'm not sure it's as big of an issue today as it was 18 or 24 months ago. I'd be curious. I know you spend a lot of time abroad as well.
Is asset preservation paramount in your investors' minds?
In a volatile world, people want transparency, liquidity, security, and that's the U.S. Okay, and that's dollar denominated. I also think a big part of this is a lot of the currency volatility is kind of euro-based, and a lot of the capital coming into the U.S. right now is not euro-based. It's Middle Eastern-based, which has a hard dollar peg, or it's APAC-based, which is a soft dollar peg. So it's less of an issue for the cross-border investors putting money into the U.S. today than it will be in, say, 24 months when the Eurozone is more fully back on its feet and more kind of expansionist in where it wants to put its capital. So I think some of it is, kind of the sensitivity of those who are investing today relative to their home currency.
And does that change, and if so, when?
Yeah, no, I think absolutely. As Europe strengthens, with quantitative easing over in Western Europe, you're going to see, German investors, European investors were a much bigger part of our vernacular probably 24 months ago than they are today because of what's going over there now. And I think in 24 months, they'll be back again. There's some stalwarts who will always be here, but for the most part, we've seen our Western European investors become quieter, and in fact, the U.S. is a net exporter of capital to Western Europe, as you mentioned with the deals that you're doing, as opposed to an importer of capital from Western Europe right now.
And Katie, you mentioned your deal in Spain.
Yes.
Is that typical of the work that you're doing right now? Are you exporting capital to Europe, and if so, to where?
Yes, at WP Carey, our globally investing is a big part of our corporate strategy, and I would say a differentiator. This past year, on behalf of our public company and our managed funds, we closed about $2.5 billion in new investments, and I'd say about 50% of that was international, from Western Europe to Australia to the US. And so because of that, currency is a big factor that we consider. So sometimes in our international transactions, we'll try to structure them in US dollars. Sometimes we'll use local denominated debt, like I mentioned earlier with the Eurobond, to act as a natural hedge, or we'll put in place just asset level hedging strategies.
But you're not ignoring the U.S.
No.
You've done some big and very prominent deals here in the U.S. Talk about some of those.
Absolutely, sure. You know, a transaction that we
It's a
closed
hard
with
deal,
some of your team at Cushman & Wakefield was with the New York Times Company a few years ago. The New York Times was looking to pay down some debt and had tried to access the capital markets and wasn't having much luck. But they did just build this brand new, beautiful Class A office building right here in Midtown Manhattan. So they came to us and asked us if we'd be interested in buying it and leasing it back to them. And we said absolutely. They had built it for about $600 a square foot. We bought it from them for around $300 a square foot so that they were able to minimize their rental payments. But we also gave them a purchase option at the end of year 10. So they could buy it back from us for a premium to what we paid, but still a discount to what it's worth. So in effect, we were trading that upside in the property for downside protection, because there's no way that the New York Times would default on their lease because they wouldn't want to lose that purchase option. So it was really a win-win for everyone involved.
Yeah, because while it was a great deal, and it was a terrific deal for you guys, a great
The
timing,
largest deal to close in Manhattan that quarter.
Great timing, great deal. While it was a great deal for you guys, at the same time, the New York Times was borrowing at 2/3 of the rate that they would borrow in the public markets. So while you'd say, wow, why would you sell at X price when you spent Y? The answer is you're borrowing at 2/3 of what the bond market tells you you can borrow at today. You got a crash crunch, and by the way, you get to buy the asset back. So that really was a win-win for both sides.
And they're the types of transactions that we like to structure, ones that are more creative and that really work for all of the parties involved.
And I wonder if they consulted the business news department on the value of that deal, and I suspect they did, and that's because the New York Times has a terrible business news department. Oh, I'm sorry. Was that editorializing?
I have to disagree.
I'm sorry. Did that sound snarky? I really apologize. So let's shift gears a little bit. In the past, PE firms have used real estate-based equity financing to fund acquisition and growth initiatives for their portfolio companies. Katie, let me ask this to you. Do you see that kind of activity in 2014? And what's your sense of real estate financing activity in 2015?
Absolutely. We work quite frequently with private equity firms as they're acquiring a new portfolio company or doing a follow-on recapitalization of a portfolio company. So basically, they realize the value that's tied up in their real estate, come to us, we purchase the real estate as they're acquiring the company. I recently closed a transaction with a company called Janus that manufactures self-storage doors. They're one of the leaders in the industry. And Sawmill Capital, a private equity firm that's based in Connecticut, bought the company, and we did the transaction buying all of Janus's essential critical manufacturing facilities.
And it makes perfect sense, as we were talking about previously. Real estate assets are relatively undervalued, especially if you're talking about publicly held companies. Public companies are now fully valued. I think everybody in the PE world is a little bit concerned about the pricing expectations for whether they're entrepreneurs, whether they're family-owned businesses, or whether they're public companies. The expectations of selling prices are just astronomical. So PE should continue to play an important part of a role in these sorts of activities.
Yes, this has been a big part of our business, and I think the private equity firms are looking at the multiple at which they can buy companies and realize that if they complete a sale-leaseback transaction, it can be accretive to the company.
And Janice, are you seeing this activity as well?
Yeah, absolutely. And the one thing I want to point out was what you said was absolutely right, kind of about a price recovery, is I also want to point out that unlike, some other markets, in real estate now, we're pretty much in a market of haves and have-nots. So while I think a lot of us talk about the price recovery and being beyond prior peak pricing, although still attractively priced relative to the other classes of foundation cities or gateway cities, there's a whole other world of real estate out there that is in secondary and tertiary cities. And we like to break the real estate world into two camps. We call it, one-strike assets versus two-strike plus assets. And the one-strike assets have done very well and are kind of fully recovered. But those are assets where either you're in, a good city in a good market, which is a zero-strike asset, or a good city but a turnaround asset, or maybe a secondary or tertiary market but a great asset. Okay, all of those assets have pretty much recovered. The rest of the world, though, which is kind of a secondary or tertiary market and a secondary asset, they're still selling at 25% plus off of prior peak values. Right. So there's still a tremendous amount of price recovery to go on in that neck of the woods. And I think that continues with better debt in the coming year and increasing traction of recovery, et cetera.
And that's where, sorry, go ahead, Brian.
I'm just more and more with our private equity clients hearing more willingness to go out to secondary, tertiary markets as they continue to search for yield, and because yields have been so compressed in the primary markets.
Yeah, that's
so
where
this may not be a permanent structural, firmament. This may be something where those tertiary markets are going to start to catch up, particularly if the primary markets, you start to find the pricing expectations to just be a little too lofty.
Absolutely. I think that, about 6 to 12 months ago was an all-time wide basis trade between those primary and secondary markets. It's narrowed a bit. It's still very, very wide to long-term averages. The only thing you need to watch out for is, we talked a little bit earlier about the millennials wanting to re-urbanize and densify. We have clients like we did the biggest lease in San Francisco. Cushman & Wakefield did the Salesforce.com lease. They moved from the suburbs to the downtown. You tell all these guys, you move downtown, you're going to pay 1.5 times the rent you were paying. Depending, it's happening in Boston, it's happening in San Francisco, it's happening in New York. So are you okay doing that? And they basically say, we can't get millennials to come to work for us. We used to put them on nice luxury buses. We'd give them free Wi-Fi, a cup of coffee, send them to the burbs. They don't want to do that anymore. They want to bicycle to work. They want to walk to work. So while we think that this basis trade is an all-time wide and there's a lot of money to be made there, you got to be really careful. Because if you're going to a tertiary market that's really far off the beaten path with no transportation, millennials don't drive. Millennials, when I grew up, when you turned 17, you went to the DMV, you got your driver's license. Now millennials have a full 15% less likelihood to get a driver's license. So you can make money in the suburbs and you can really lose money in the suburbs. You have to be really particular about what suburb you're in and whether it's a millennial-friendly suburb.
It's really, sorry, I interrupted. It's really important to remember that also the more tertiary you go with markets, the more exit risk you take on, the less liquidity you have to get out of that investment. So there are other challenges. And when I was talking earlier about current return versus residual return, you start to take on more residual return risk when you start to go more tertiary.
Yeah, at WP Carey, I think in some of those, I like the strike markets that you're describing. That's where we see some more opportunity. The way that we look at each transaction is a balance between the credit of the company that's entering into the lease, the quality of the real estate, where it's located, how old it is, what type of asset it is, and how important that facility is to the company. So in the zero strike markets, pricing is incredibly competitive, but if you're entering into a 15 or 20-year lease in a secondary or tertiary market for a critical facility, that's where you can get a little bit better yield. So a recent transaction that I closed was with a company called Pratt. They manufacture cardboard boxes, and they had a manufacturing facility in Lewisburg, Ohio, which is a suburb of Dayton that I'm not sure if you're familiar with, but they were building.
I thought Dayton was a suburb.
They were building a new corrugating facility right next door and were willing to enter into an 18-and-a-half-year lease. So it was a critical operation. They're a strong company, and that's a good example of an opportunity in a secondary market that was able to deliver very attractive risk-adjusted returns.
And we're seeing this mirror demographic trends. I mean, demographic trends are saying that urban areas are being revitalized. You're seeing, areas like Philadelphia or Cleveland or others that seemed at one point to be almost dying communities are now becoming revitalized and are actually attracting a younger workforce that wants to do exactly what you want to do. They want to bike to work. They want to be able to live near where their employer is, and they want to be part of a vibrant local scene. And obviously, that has to come at the expense of some of the tertiary markets, which brings me to my next question, which is about the expansion of the workforce. What does this do? And Janice, let's start with you. Does the expansion of the workforce, does the rising tide lift all boats?
Yeah, no, it's a great thing. I mean, the one thing that the U.S. has for itself, which is driving a lot of foreign capital here, is that we have net population growth. If you look at a lot of the Western European markets, if you look at Japan, a lot of these places out there, the mature, safe markets that people would otherwise put capital into, a lot of them only have replacement demand, because they don't have growing populations. So the only time you want to build a new building is when the old one falls down. Okay, but the U.S., we've got 1.2% growth. That's a terrific thing. That's absolutely in our favor. It means that the construction numbers that we've got on the board are absolutely sustainable, and that from a mature market perspective, if you're looking for a safe place to put your money in the world today, it's looking like the UK and the U.S. Right? Other markets you might go there for growth, you might go there for opportunity, but for safety and security and stability. AFIRE every year does this poll. It's the Association of Foreign Investors in Real Estate. And they have a poll for the safest markets, and they have a poll for the markets with most capital appreciation. The U.S. is at the top of both lists. So we're safe, we're secure, and we've got a lot of capital appreciation. That's a pretty winning formula, and it's because of this population growth. It's because of this employment growth situation.
I'm seeing the same things, and we talk about fundamentals. The U.S. really has the best fundamentals going right now, and the rest of the world knows it. Yeah. And so like I said, all arrows are pointing this direction right now. It's going to present a very challenging market, I think, for the whole world as they point their efforts towards the United States over this next 18 or 24 months.
And Katie, while you're obviously invested in the U.S., are you seeing opportunities to capitalize on population growth internationally, or is it, as Janice is explaining, we're simply tearing down decaying infrastructure and replacing it with new build?
Yeah, I think in general, people need places to work, and in improving economies, there's going to be new buildings and expansion of companies. There are some interesting trends, though, going on, I think, in terms of office space, for instance. There's a shift towards more hoteling and smaller square footage per individual, so I think that has a bit of a counterbalance on the increasing labor and its impact on real estate.
So then is the opportunity in terms of job category, is it purely office space? Does it mean financial services, business services? Are there opportunities for retailing, manufacturing, other types?
All of the above. We invest in all sectors and in all asset types, but it is interesting to see kind of the changing demand for different types of real estate. So for instance, retail. In the US, there's a much more of a shift towards online shopping, same-day delivery even in some places, and so the distribution facilities are becoming a little bit more of a critical facility as opposed to the individual retail outlets, in our opinion. Whereas in Europe, for instance, the retail outlets are more valuable because there's more difficult zoning and more difficult development rights. So we're looking in the US at more distribution facilities and for retail companies. Internationally, we're open to investing in some more retail stores.
So what about pricing for those things? Can you price a distribution outlet the same way you can price a commercial, an inner city commercial real estate property?
No, the pricing is very distinct based on the asset type, and again, based on the credit of the tenant, the quality of the real estate, where it's located, and from our perspective, how important that asset is to the company. So it's hard to make an argument that an individual retail store is critical to a company's operations, but you can say a distribution facility that manages 50 of their retail stores is a little bit more critical.
And yet, if you're Amazon, for instance, you're building distribution centers everywhere.
Mm-hmm.
You're no longer building, distribution centers in 5 strategic locations. I order from Amazon today, and I get delivery tomorrow. That means that the distribution hub is located close to where I live. So is the expansion of the distribution making up for any inequality in pricing?
I'd say that's another trend, definitely, the streamlining of the supply chain. And we're seeing a lot of build-to-suits in that area to build these large distribution facilities, and then smaller rapid deployment centers, so it's easy for you to get that next day delivery. And so for our build-to-suits, we fund 100% of the construction cost, and again, enter into a long-term triple net lease. So we're doing right now a transaction with a company called Belk, which is a department store that you may be familiar with. They had an existing distribution facility, that they wanted to expand because they're undergoing such growth. And I think that's just another trend in this economy where companies are growing, companies need new space.
But a case in point on this trend is if you take a Best Buy. Best Buy, their prototypical floor plate used to be, I'm a Best Buy, I want to be 49,000 square feet. Okay, because I've got my front of the office and I've got the back, where I store stuff that I sell. Okay, now Best Buy's prototype is more like 17,000, 19,000 square feet. So there's still real estate demand, but the demand has shifted. And I like to call industrial the new retail, because what Best Buy has done is basically said, relative to this hub and spoke model that everyone's talking about in terms of supply chain, I'm going to put all the stuff that I know I'm going to restock on a daily basis, and I'm going to put it within an hour of the city, and I'm going to come in every day, and I'm going to restock that. But instead of taking all of that more expensive retail space in the city, I'm going to have a nice, shiny high street or a fortress mall kind of storefront, and I'm going to encourage people to buy it and have it delivered to them in 24 hours instead of taking it home with them.
And I can testify to that because now I live in Manhattan, and there is a Best Buy literally on the, outside my subway stop. And it is probably the smallest footprint of a Best Buy that, when I go to the suburbs and I see a Best Buy, I look around and think, wow, look at this place.
Yeah, you could
whereas,
yeah.
Whereas the one the ones in the suburbs, I could drive a horse through. The ones in the city, I couldn't drive a big wheel through. And yet, it's got everything I need. Every time I go in there, it's
24-hour resupplying.
And so somewhere out there, there's somebody who's bringing this product in. Brian, where are you seeing on a industry by industry breakdown? Where are you seeing demand?
Well, the multifamily sector, remains, very compelling. You look at the long-term supply and demand fundamentals for multifamily. I think that you were saying this earlier, Janice. I remain very positive, actually, long-term on multifamily. Are you referring to asset classes? So if I'm going the right direction with this, so multifamily remains, an asset class that I think is going to be very compelling for quite some time. I'm fascinated by the fulfillment center retail dynamic and what's going on there. And as I was listening to the two of you talk, I was thinking about just how much technology and the internet has not only affected the technology business, but how much it's affected the real estate business and office and how people office, how people shop, and just the future, and just wondering what in 5 years it's going to look like. So,
now let's shift gears a bit. Geopolitical risk is, part of our lives every day right now. Janice, how do you calculate geopolitical risk? Do you just have to ignore the fact that somebody could,
Well, Cushman & Wakefield thinks this is huge, and for this reason, I don't know if you know this, but we hired Ray Kelly, who is the ex-police commissioner. So thank you for doing that. But because it's a huge issue, and it's not only physical risks, which we deal with now, but it's also cyber risks, increasingly. I mean, when you pull movies because of cyber security issues, it's really huge. So we think that this is one of the huge issues that, as an industry, we have been challenged to deal with in recent history. And part of you is like, you just don't want to look because you're so scared if you look at it, what's really going to happen. But what we've done is we put a huge effort into, starting with, kind of retail storefronts, how to secure, how to have emergency plans, how to have best practices. Whereas before, a mall was like, gee, you go there for fun, it's a nice place to shop, and, everyone's a good citizen, so you think all these good things. Now increasingly with Ray, we go into people's portfolios and take a deep dive into, the what ifs, and, you hope for the best, but you plan for the worst, right? And you secure yourself against the worst. So both from a physical security standpoint and a cybersecurity standpoint, we think this is one of those huge issues that people really haven't effectively priced for because they just don't know how.
And you're not only talking about, we all grew up at a time when you were, the terror was, there was a madman with a finger on a button. You're now at a risk where there are communities in which there could be a wave of violent protest that could swamp just about everything going on. And Katie, how do you calculate that? How do you assume? The New York Times building would be, I was in Times Square during protests over Don't Choke Me, and it consumed that entire community.
Yeah, I would say that we have a very disciplined investment approach, and I look at this risk a lot for our international transactions in particular. So for each international deal, we're constantly evaluating what's the political situation, what's the economic situation, what's the legal situation, the tax situation, to make sure that our investors' funds are as protected as possible. We also have a third party, an outside investment committee that's comprised of the former heads of bond departments, Wharton economics professors, and actually Professor Dick Marston from Wharton, for every country that we go into, he'll provide us with an analysis that we include into our report. So we're always evaluating and thinking about this risk as we're doing new transactions.
And can you insure against it?
Yes, there is political risk insurance that we have considered in different opportunities.
Our view is it's out there. It's unfortunate. You have to deal with it. We're trying to help our clients mitigate it as much as possible, and when those events unfortunately will occur, is to try and keep the volatility, the reaction from an economic perspective as short as possible.
Yep. Now, talk about the investing climate in this low rate environment. Can you pretty much price any deal, Brian? Can you if you find a deal, you find something attractive, are you able to just is there a turnkey method for saying, all right, now we've got all the capital we need to make this done?
Well, I mean, you can price it however you want. You know, there's
Yeah,
no,
we're just, we've established what kind of deal it is. Now we're just haggling over the terms.
But the problem is there's 10 other guys right next to you with no shortage of capital. All willing to pay cash, all willing to execute tomorrow for the right asset. And so what I was saying earlier, remember, too much capital, too little supply. That fundamental is affecting our business as much as anything today. So yes, it's a very fully priced, very mature market. And I keep coming back to this. The reason I'm not willing to call it a bubble is because I don't think it's close to a bubble. I think that we've got great fundamentals. One of the challenges that I struggle with, and I would be really curious to get your guys' thoughts on this, is if you believe that the bottom of the market was, call it somewhere in late 2008 or early 2009, we're basically 6.5 years into a recovery, thereabouts, right? And yet we're 6.5 years into a recovery with essentially no inflation and no real kind of clear sense for where we sit in the cycle. We've got nice recovering fundamentals, but I don't think we've ever gone 6.5 years into a real estate cycle ever.
We should be in the next cycle.
And be at the point that we are now. And so, we spend a great deal of time thinking about how to sort of protect that downside risk, and what are the things that, someone once said the unknown unknowns that we're trying to get our head around, because we are in uncharted waters. And so if you ask me what made me nervous is the fact that we're in uncharted waters in terms of a real estate cycle. We're in uncharted waters in terms of central bank monetary policy. And it's those types of things that something from the blind side could come out to surprise us with.
And
Yeah, but
Janice, what about this extended cycle?
In the beginning, we had a jobless recovery. And what is real estate? Real estate is a wrapper for people. So if you don't have the jobs, you don't necessarily need the real estate. So, so while we nominally had a recovery, from an economic basis, on a GDP basis, we had effectively a jobless recovery for a sustained period of time. So I would actually take the first couple of years of that and chop that off and say that doesn't even count as recovery, because GDP was growing, but from a job growth perspective, we weren't doing anything. Now, though, we're starting to see real job growth. So, whereas typically you'd see a 7 to 10 year cycle and you'd say, gee, shouldn't we already be in the overbuilding, oversupply, headed down, because we're a cyclical industry, that's just what we are. I actually think I started by saying, this is a boring recovery. Boring is good. Boring extends the length of that cycle. I mean, I think we're going to see, I'm not worried that we have one more year and then we're down. I think that we've got some kind of good economic growth. We've got some good job growth prospects. And I think the length of the cycle is going to be longer, because the first couple of years, I think, didn't really count because we didn't see the traction.
It was a liquidity-driven cycle at the start.
And Katie, does the ride go on forever? I mean, do we just?
I don't think it can go on forever.
Does the music never stop?
I think it has to stop at some point, and hopefully we're just prepared for that and have underwritten our transactions in the right way. We're a constant source of capital and can invest through all cycles. So in a growing economy or a positive economy, there's demand and need for new space, and companies are growing. In a downside cycle, there's less alternative sources of financing, and really that's what a sale-leaseback transaction is. So we can invest throughout all cycles and just have to be prepared and cognizant of what's going on in the market at the time.
Right. Katie brings up a very important point, which is, and as I know you do as well, we try and help our clients invest through all parts of the cycle. And that can be ranging from where to deploy capital, to how much leverage, to what the length of the investment term is, and so on and so forth. So we're trying to adjust those factors as we go through different parts of the cycle.
All right, one word answers from every one of you.
Yes, no, maybe.
When does the cycle stop?
One word?
When does the cycle stop?
Interest rate spike.
When does the cycle stop?
Interest rate spike.
They stole mine. I'd say the same.
Okay.
Yeah, it's all about liquidity.
It's all about liquidity. So Janet Yellen runs your business.
Yeah, I said this earlier. I think Janet Yellen is much more dovish than she's willing to admit, and I think she wants to see real wage growth return to long-term levels above inflation.
Yep. And real wage growth brings up a question. You talked about multifamily construction. Is there pricing liquidity in multifamily dwellings, and can you make the economics work to continue to do this construction if my wages are continuing to trail inflation?
Very, very, very valid question. So far, the answer is yes. The question is, are we beginning to approach it, a more rigid ceiling? In order to have rent growth, you need to have more money in your pocket every month to pay that rent, right? We've seen in past cycles a 50-cent per gallon change at the gas pump can affect a person's ability to pay and therefore your ability to drive rent growth. So there's no question. But right now when we look at that, and this is different in different markets. Obviously New York, San Francisco is going to be a different discussion than some other markets. But right now we seem to be seeing an ability of that tenant to make that rent payment with increasing rents. Whether it continues or not, we'll have to see. Obviously, declining oil prices help everybody in this particular instance.
And we're an aspirational society. Everybody wants to. I'd like to move into a place with one more bedroom and, for God's sakes, an extra closet, because the one I've got is just littered.
Oh, but you're not a millennial. So absolutely. I mean, I think you have to look at the generational kind of differences that we have. And the millennials, that commercial, it's not your father's Oldsmobile, it's all about them. So those millennials, like I'm like you, I'm an Xer, Xers and baby boomers, you want that extra closet, hopefully it's a shoe closet, and you want, more room to put your stuff. And millennials are saying, I will take smaller micro apartments in live, work, play markets. I'll share for longer. I don't necessarily want to own. So this is a huge generational shift. And it's, as we said before, some of this is uncharted territory. Why is it? Because millennials on average are 23 years old. And you vote with your pocketbook, and they were underemployed up until just recently. So we didn't really care because they weren't voting with their pocketbooks and they were living in their parents' basements, but now they're coming into their own, okay? The job market is back. Hopefully if you have a millennial at home, they're out of your basement, they have a job, they're moving out on their own, but it's not a generation where they're going to spend $200 on throw pillows and want bigger and more. It's a more social generation. If you look at the polling, and I'm not saying this is who they're going to be eventually, because remember, the boomers were the peace, love, free love generation, and it turned into the most materialistic generation on record. But who the millennials are today, and what we can see in the next 5 to 10 years, they may change when they have 3.2 kids, but they're getting married later. They're getting married 5 years later. They're having kids later, which means their multifamily rental years are longer than prior generations. They want to be in the downtowns. They're willing to take smaller, living accommodations to be in a live, work, play area. And, this is dramatically changing the composition, of our multifamily market, and of our office market.
And your focus on demographics is really fascinating and extra frightening because they're going to be running the senior center home where I'm going to be living one day.
With a very large closet.
Yes, with a really big closet.
We have just a moment or two left here. Katie, I'm going to go to you. Just give me broad strokes, your outline for the commercial real estate market over the next 2 years.
I think the commercial real estate market will stay strong, and again, it will be driven by the interest rates. And I think that the Fed will manage a steady increase of interest rates.
Janet.
I actually think I was more scared 12 months ago than I am now because pricing is always ahead of the fundamentals, and the fundamentals have started to catch up. So we're seeing traction with the economy, we're seeing traction with real estate fundamentals. So I feel good for the next 12 to 18 months, but I think as we all said, if we get a black swan event, if we get a huge spike in interest rates, we reserve the right to come back at that.
Unforeseen,
yeah. Unforeseen event.
All right, when we have the black swan event, please all four of us convene. Brian, your final thoughts?
I concur. I think the fundamentals are there. They appear to be showing long-term sustainability. The question is the unknowns in terms of liquidity and how our central bank unwinds. And then I think some of the risks are some of the external forces at play that could cause either the Fed to have to change its game plan or just completely throw the plan out. And it would be something that would be not planned for.
Great. Well, we've got some optimism about the outlook, the outlying events, notwithstanding. I want to thank you so much for joining us today. A very lively discussion with a lot of insight. I want to thank our colleagues at WP Carey for underwriting this event. And lastly, the replay link will be up on The Deal early next week. I'm Bob O'Brien with The Deal. Thank you to our distinguished panel. Katie, Janice, Brian, thank you so much for sharing your interest in this fascinating market. I want to thank you for watching, and please tune again to The Deal. Thank you.